Hi, everybody, and welcome back to video number 5 in chapter 23. And when we left off, we were looking at our next learning objective, and that was to identify the major disclosures in the auditor's report and understand management's responsibility for the financial statements. The auditor's report could have an unqualified opinion. And that's where the auditor expresses the opinion that the financial statements are presented fairly in accordance with GAAP. That's, of course, what you want when you have your auditors in. An unqualified opinion example here, I'll let you read this on your own, but here's the board of directors of Nike, and it includes some key terminology here. One, that the accompanying financial statements fairly present the operations of the company. And then they've also audited internal controls in accordance with COSO, the Committee of Sponsoring Organizations of the Treadway Commission. And then in their opinion, they have said that everything's good to go. And then they have a basis for their opinion in that they maintained effective internal control over financial reporting, etc., etc. And because Nike is a publicly traded accounting firm, it's registered with the Public Company Accounting Oversight Board. That's United States, PCAOB, and that's part of the SOX. The PCAOB is part of SOX, and they have passed with flying colors. And PricewaterhouseCoopers is one of the big four, and PricewaterhouseCoopers is a limited liability partnership as well, homeported in Portland, Oregon. Okay, so here an explanatory paragraph. Certain circumstances, although they do not affect the auditor's unqualified opinion, may require the auditor to add an explanatory paragraph to the audit report, indicating it's a going concern, lack of consistency, and emphasis of a specific matter. So, this qualified opinion contains an exception to the standard opinion. Unusual circumstances may include 1, a scope limitation. What they saw was good, but they didn't look at everything. And number 2, the statements do not fairly present the financial position or results of operation because of alpha, lack of conformity with GAAP, and bravo, inadequate disclosure. This is a qualified opinion, not an unqualified opinion. Okay, the Helio company shows here that company has excluded from property and debt in the accompanying balance sheet certain lease obligations that, in the opinion of the auditors, should have been capitalized in order to conform with generally accepted accounting principles. And then they go on to document what that would mean if they were capitalized. And so that would have an effect on decreasing earnings per share by 6 cents and 4 cents per share. So in their opinion, except for the effects of not capitalizing those certain lease obligations, the financial statements referred to above did fairly present in all material respects the financial position of the Helio company and the results of its operation and its cash flows for the years then ended in conformity with generally accepted accounting principles as well. An adverse opinion would be the third kind of opinion. Here, that's required in any report in which the exceptions to fair presentation are so material that in the independent auditor's judgment, a qualified opinion is not justified. The financial statements taken as a whole are not in accordance with GAAP. Alpha, adverse opinions are rare because, bravo, the SEC will not permit a company listed on an exchange to have an adverse opinion. Disclaimer of an opinion. Here, it's appropriate when the auditor has gathered so little information on the financial statements that no opinion can be expressed. I had a situation like that personally when I audited a nonprofit who was very proud of the fact that they had a paperless system, and the CEO of that particular company was very proud of that. However, his interpretation of a paperless system meant that there was no documentation supporting the journal entries. Not a good situation. So naturally, I helped him fix that system so that it was in conformance. But that would be an example of a disclaimer. I couldn't express an opinion because I couldn't audit the transactions. All right. Management discussion and analysis, often referred to as an MD&A, that's required by the SEC. And that's a really useful document I've found. The management highlights favorable and, for that matter, unfavorable trends related to the liquidity, capital resources, and results of operations. And it identifies significant events and uncertainties that affect these three factors. So it's always good to see what the knowledgeable insiders are saying about their company. All right, here's one from PepsiCo Incorporated, and they're talking about business risks, risk management framework. And so part of that is the achievement of their strategic and operating objectives involves, of course, taking risks. And those risks can occur over time. So they here, their market risks that they're specifically exposing are commodity prices affecting the cost of the raw materials and energy costs necessary to make their product, foreign exchange rates and currency restrictions, and interest rates. I'll let you read this on your own. But part of what they do to mitigate those risks is hedging and other mitigating techniques that they are using in their company. All right, so here's a review question. Let's take a look at that. The MD&A section of a company's annual report is to cover the following three items. Alpha, income statement, balance sheet, and statement of owner's equity. Bravo, income statement, balance sheet, and statement of cash flows. Charlie, liquidity, capital resources, and results of operations. And Delta, changes in stock price, mergers, and acquisitions. So if you chose answer Charlie, you would be correct. Liquidity, capital resources, and the results of operations, as well as their projections on some of their implemented management approaches. All right, I talked briefly about Sarbanes-Oxley, but Sarbanes-Oxley, or SOX, requires the SEC to develop guidelines for all publicly traded companies to report on management's responsibility for and assessment of the internal control system. In my last position, I was the SOX coordinator, and we were required to do over 100 audits every quarter that were not done by the finance and accounting staff. I had to then train the people in the various functional areas, manufacturing, purchasing, sales, etc., to do that auditing. 100 of them each, more than 100 of them each quarter. And then I was supposed to assess the results of those audits, look for control weaknesses, and implement any changes that would better provide for better internal control. And then at the end of the year, our outside auditors would audit what I had done and make an independent conclusion based on their review. Very costly to do Sarbanes-Oxley. All right, so here's a report on management's responsibility for Starbucks. And here they have a disclosure of controls and procedures and a report on management's internal control over financial reporting. Again, I'll let you read this on your own, but essentially it's what we have been talking about: assessing internal control, and that is important in ensuring that we accurately report what's going on in the company in our financials. Okay. All right. Identify the reporting issues related to fraudulent financial reporting and financial forecasts. Here, intentional or reckless conduct, whether act or omission, by act or omission, that results in materially misleading financial statements. And there are several of them that are very well known, especially to me, involving Enron, WorldCom, Adelphia, Theranos, etc., that indicate that much more must be done to address that issue. Congress got involved and established SOX, and very expensive to do SOX, but I would also say that we have not had major fraud subsequently as a result of that. Some very well, in the case of Enron and WorldCom, those were famous examples of Arthur Andersen, who eventually went bankrupt because they were the auditors on Enron and WorldCom. And instead of the big five auditors, now it's big four auditors. Okay. So the general incentives for fraudulent financial reporting. Why would we want to do that? Well, to obtain a higher stock price, especially if our compensation is based on that. Maybe to avoid default on a loan covenant, or to make a personal gain of some type, additional compensation, promotion, bonus, something like that. That looks like a good place for us to end this video, and when we return, we'll take a look at opportunities for fraudulent reporting. Until that time, bye for now.